There we go. All right, happy Father's Day, everybody, and JT. We'll keep it kind of brief tonight, obviously, because you guys got family stuff.
Yeah, and this week is like crazy. Like it's just a shit ton of things.
Wait, what? This week?
Yeah, this whole week. Like we've got Juneteenth, we've got OPEX, FOMC. Like there's just a ton of things.
No, it is kind of funny. And Wednesday is kind of wild. We have VIX expiration falling on the same day as FOMC, falling on the same day as what generally is a difficult day because the last day to trade SPX AM settled options.
Yeah, like it's
That's
going to
rare.
be just a crazy week.
Yeah, I don't think we've had this before where June expiration had been situated in front or right behind this holiday because Juneteenth didn't exist. Probably the last time this would have fallen this way, right?
Yeah, I think it's like a 7-year cycle or something that it kind of ends this way with all of the things in front of it.
Yeah, it makes sense.
Yeah, and I think Juneteenth's what, 3 years?
Yeah,
Like
about right. It's pretty fresh.
Yeah.
So it should be interesting. It's going to be an interesting Wednesday. It's like a strange unclench and then settling the big June positions is going to be interesting. There's obviously this is a strange geopolitical moment. What's really interesting to me is what might happen when we open tomorrow with the VIX, right? You guys probably have seen. I didn't even intend to come at this one Z contrarian guy or whatever. For anybody who's listening and following along, I follow that guy. I think his takes are fine. I think his takes are fine. His trades are fine. But the point I was trying to make, if you guys are aware, the 1x2 idea, being naked short VIX calls, which you are in a 1x2 structure once VIX goes above 30. I guess technically you're really naked short above 40, but it's not a safe trade into an expiration with negative upside gamma in the VIX complex and also geopolitical tensions spiking across the world. Nuclear tension is never something good for volatility, especially when it feels like everybody's already been kind of baited in with this idea that the market can absorb anything. It's like, well, we'll see. Maybe it can't though.
Well, and there's also just the local political influences too, right? The week was the last week for Iran to get a deal with their 60-day pause, right? And going into news of the attacks, we had information that the administration had cut off communication with Iran regarding trade stuff. So they don't even have necessarily U.S. support economically right now to get some of those things going. Whereas if they had a really good deal going or something, you could expect the administration to be a little bit more involved to keep that, but they're not having those either. So there's really just a lot of reasons here that this could just be a volatile week.
It's kind of all bets are off, and you also have again, I give anybody credit who's able to still pay attention to the news. I have to call people and be like, hey, what just happened? Or I have to have people that I talk to can you just explain what's going on in the world? Because I never pay attention. It's just too much. Lines are clearly impactful when you have situations like this, but the market, right now it almost feels like what it felt like in February of this year.
According to COVID?
And, well, not quite that bad. I don't think February of 2025 gave the same vibes. I mean, it's similar thread, but different magnitude, right? So we're getting kind of the same vibes where the market's absorbing anything. And I've seen the same accounts that I respect a lot retweet the same idea that when the market's absorbing news like this, it just tells you something about the strength. It's it does and it doesn't. It's it can change on a dime. Just like during COVID, it snapped at expiration. And then this year, February, it snapped after the VIX expiration and then the regular expiration. It can snap again just on nothing really that's visibly escalatory when it happens. Yeah. We've already had all the escalation in the background kind of bubbling up of risk. And you can see last weekend when we did this, that was last weekend, right? We had this on. Yeah. Yeah, it feels like so long ago. We talked about spot up, vol up. And then Monday we had a trivial case where really spot up, vol up happened. I mean, scam exposure, I love you, dude, but I think you called me out for being right. I would not actually, if he's even on the call, I don't know. I would not actually call because what happened Monday of last week was more we just shifted the VIX window, which technically perked up the VIX cash because of shifting from capturing June 27th option chain to July 11th option chain, which then included the tariff stuff. Because there's this deadline that I don't even know if people remember. I didn't remember. July 9th. This idea that we're going to have some kind of deadline on July 9th. So again, we have this strange thing where there's always this buy the rumor, sell the news pension where we never have resolution, but a reason to keep the term structure steepening. But now ahead of the VIX, you kind of see we have some risk bubbling up, which tends to happen, I think, ahead of the VIX expiration. And we may see, I would be concerned if I saw an increase in realized vol tomorrow. And then again on Tuesday, I would not feel safe with short upside VIX calls. I know they're going to be very cheap, but if they're very cheap and you're short them because you're in a structure like this 1x2 that I was originally referencing, just buy them back. Pay
or hedge it.
Yeah, well, yeah, VIX is difficult.
Fly it off.
Exactly. Yeah. I mean, when this trade was open, you could have bought the 35 calls probably for very cheap. The 2030 call 1x2 in June, you could have bought the 35 calls probably for very cheap to not really ruin the trade. But we'll see what happens.
And you could take some short-term use cases, and I don't know when the expiry of this particular 1x2 was, but like
It was this week.
if you're so it expires this week.
Mm-hmm.
Yeah, I don't know if short going into an expiration like that. That'd just be weird.
They're going to be so cheap too. Like just buy them back.
Yeah, that'd be weird. And it doesn't make sense because I would hedge it off for sure. Like there's really no reason to carry into an expiration. You hedge it off, like especially if like you want to continue a position or roll it. If I was already in a VIX position, that wants upside, I would definitely be considering rolling anything into the next week or two.
It's just not a responsible hedge. I mean, my big thing too, like you have to be careful what you say to people in this space. I see a lot of big accounts on here that seem to communicate responsibly, like UVSY Trader. I see listing like good accounts that communicate, I think, in a way that's relatively responsible. And it's funny, like everybody kind of toes this line, like, oh, not advice. Like this one account actually declared what he was doing as advising, but it's like I'm pretty sure FINRA and SEC take a more scrutinizing eye when you go beyond simple equities and into volatility, let alone volatility derivatives. So by the time you're talking about VIX call, you better be giving some disclaimers about the real risk of the product, especially if you're doing anything that's remotely like quote unquote advice, which you should not be doing anyway in the scope of this. But
you shouldn't do it unless you're actually licensed. Like,
yeah, you shouldn't be cavalier about it either way. But
and to be fair, like if you are in that space and you are knowledgeable about that stuff, like it's really not that difficult to be credentialed and communicate in those ways. Like if that's what you want to do, don't do something that you shouldn't think though. Like that's just, there's a reason compliance in general exists.
When I just know when VIX options blow out, I mean, I have like Groundhog Day memories in the SPX where like things go crazy and the SPX is fine. Like we'll be like it'll be like multiple stages through a break where people are like, man, things are finally wide. We would sit there and complain like, why are markets so tight? Why are markets so tight? And like all of us from every group would look around and be like, why are markets so tight? Like, dude, we're all the ones from market making. We'll just realize we're not pricing risk well. VIX is kind of different. When things go haywire in the VIX, it just blows apart. You don't really have markets to trade. It's not like a retail friendly product.
It's definitely not a retail friendly product.
It's dangerous. At least, I mean, I always tell people like, whatever you do in the VIX, like don't veer from the main contracts. Like when you go into like weekly things like that, they're just so liquid. You're not going to get good fills either way, and you really don't know where it's fairly priced. It's just a nightmare.
So we're talking about OPEX, and we're kind of going into that OPEX period. How does the OPEX period how does it cause some of this volatility? Obviously, positions are kind of rolling, but what does that do to the landscape, and why is it kind of potentially more risky when we have all this extra risk we see from the news and all the events and every announcement possible, right?
Yeah, I mean, there's a lot of repositioning, and there's a lot of narrowing and localizing of the different positions that are out there in the near dated. And also some of the repositioning too, I think people don't realize there are structural positions. Also, a lot of the structural positions are in some form or fashion selling delta. And so when you roll these, there is a little bit of delta impact just for sale, right? Because if you're talking about things that are out of the money and we're rolling them again, there is a little bit of that going on. I think that happens in the VIX as well, where you see things like this Roofer or 50 Cent, whatever they call that fund, that buys these calls. Like these are relatively straightforward and typical of this space now. And so like when you have this expiration, it's like a lot of the stuff gets moved out in a way where we might have some pressure come off, but it's actually like the vol complex is funny because you're going to have the replacement, the replenishment of hedges in the VIX complex too. And I know we're kind of talking about both VIX and SPX, but then SPX, some of the moves we get in SPX, I think, are related to things OTC as well. Like we're going to probably have a bit of move on Wednesday. You guys have probably realized that a lot of times we have move in the index that are larger or more, more significant on the VIX expiration than on the actual options expiration. It's not always the case, but it's sometimes the case. And there are also big positions that happen. Like when VIX expires on Wednesday, there's a big basis trade that's likely to be settled or expired with it, where people like trade out of a lot of options into the open. They wind up closing kind of this multiple-legged structure to arbitrage away the spread between the actual calculated VIX value and the VIX future tradable price. Just very noisy, very messy. And also there's this idea that if you think about the options position in general, like with all these different participants in the space, there's mostly selling options and there's some hedging around quarterlies and all that kind of stuff. But for the most part, all these option selling programs wind up doing things where they're piling into different days on the calendar And then because of the nature of it, so like if some firms sell Monday, Wednesday, and Friday of every week, and some firms sell every single day, and some firms sell every Friday only, and some firms sell every OPEX serial only. At the end of the day, the serial OPEX portion of the inventory tends to accumulate the largest pile of gamma. Does that make sense?
Yeah.
It's like you just keep stacking on these things, and if you just play the game with the way the different participants are structured to sell their whatever their expression is of selling volatility, it tends to be such that like the OPEX week just accumulates the most because it actually has the greatest overlap with all the different products. So it'll be interesting.
And then kind of tying into that, that last statement, they have January and June, which has, of course, the ever so popular leaps, which actually does have quite a bit of volume in them over the course of 2 years by the time they come up to expiry.
Interesting. I always knew January would have a lot of leaps, mostly because people use it to arb like index products. We kind of wondered, like, we always had a lot of positions built up in Jan, far out, like a year ahead of time. But we'll see what happens this time. I mean, what's interesting to me too is if you look at the positioning, there's this idea that like we're going to have. I mean, everybody's assuming that OPEX. I shouldn't say more and more people are aware of real dynamics, especially people on this call. But people do assume that OPEX is supportive. There's certainly an element of support going on right now, right? But what I tried to communicate last week, and I kind of broke away from the original point of this, like the technicality of the spot up, vol up last Monday was just that. It was a technicality. It wasn't really a strong case. And spot up, vol up, again, does not mean like a pure correlation where like you're going to see it intraday and close. Like it reflects a certain thing going on in the vol complex where market makers actually have a non-traditional position. And it's not stable. Like if vol is going up on a rally because of the position, well, all it takes is someone to turn around and start selling vol, and the correlation can break, right? But the fact is, what the positioning is like right now, going into this period, is very much it's a confusing level of support. It's like because the market making book is inverted in July, it's very much like a spot up, vol up impulse. And so the strange thing about right now, we have this political tension bubbling. It's causing cross asset volatility and real risk, but it's probably being ignored because of the extent of the bid in the market. But the problem is right now that if you're just rewinding back to like first principles of the roots of my system as a marketer, I'm generalizing, I'm not in a seat right now, but I can look at the position and tell you what we'd be doing. If you raise volatility, which has been what happened into the end of the week, it actually causes our systems to buy futures. It's very basic, and it's because we have a long skew position, and it's local.
Yeah.
We're not long skew farther out of the curve, and there's still like a tremendous amount of hedging and normal skew positioning, like 6 months out, 12 months out, et cetera. But right now, for whatever reason, I was pressing 6,000. There's been a lot of overwriting into 6,000, but a lot of hedging of this breakout to new highs. So if you look at the positioning above like 62.5, it's all net bought. Customers own calls. They're probably non-committal on the equity side. They don't want to be fully invested here because they see we've had a tremendous retracement. But maybe things aren't resolved yet, and maybe we're just going to have some delayed impact from whatever noise has been going on the last several months. There's a number of reasons you wouldn't want to be fully invested right now, in my opinion. But maybe you also don't want to be fully in cash. So what do? You just do a little bit of equity replacement. You swap out some of your allocation and buy calls. Right now, that's July. And July is doing this weird thing right now where when people buy VIX futures or when people buy VIX calls or even just buy vol, it actually puts pressure up on the index. And that's only local here. It's pretty neutral at the moment, and it will fade if we even slide back down like another 1 or 2%. So that's where like we have a strange tension that people don't understand, that the support is misleading. Hopefully that makes sense. I know it's kind of a lot to wrap your head around, but I hope it's somewhat sensible.
Yep. No, it totally makes sense to me because I pay attention to skew, so I enjoy skew. Let's see. I was trying to look and see. Let's see. We had some questions. So from IPR, so does that mean the VIX and similar vol products are the tail that wags the dogs rather than just the index? Do you think that, like, the interpretation of this question is, do you think that VIX has a chance, the options themselves has a chance to like really strongly lead the SPX, or
oh my goodness,
vice
yeah,
versa?
this is like a layup, right? Yeah, I mean, obviously, I think so, and I think it's dangerously so. And it's not like it's also like you could see the bubbling up of this for a while, and it happened in like really severe case last summer, where the VIX
I was about to pull out the last August.
Yeah, it was massive, and that was really coming from the VIX complex. I know everybody kind of interpreted it as like the yen carry trade, and of course there's something going on there. But the point is, like, what winds up happening is we start blowing out VIX gamma, and at the same time, like, you're pulling liquidity out of the system too. I'm sure the yen carry trade is not bullish for book depth in ES either, the unwind of that thing. And so in the end, what you have is like a situation where liquidity is disappearing, but then the contract that has the most like bang for your buck in terms of leverage, moving the real underlying index at the end, is the VIX. You blow out the VIX contract, and like you look at what happened on August of last year, like that Sunday when the real happened. Like yes, obviously notwithstanding the VIX did not go to 66 or some stupid level. Like even the futures went to a really significantly higher move that Sunday into Monday. And like when you do that and you actually simulate the shock to the portfolio of the market maker's book, it's like instantly requiring tens of thousands of futures for sale into this market. And that wouldn't have happened, if the positioning was inverted for some, what have you. Like that would have instantly required tens of thousands of futures to buy into an offerless market. And so it's a strange thing right now where, I almost think of like the index as the dog. And so I think of like maybe the VIX, maybe could be, or the options could be the tail of the dog. And then I say this all the time, like we have a situation where like the tail of the tail wags the dog. It's like the VIX options can wag the VIX, which just destroys the index sometimes.
Yeah, I think of it as convexity on convexity on convexity.
Yeah, vol. And it's not even it's not even macro. It's not even fundamental. There's nothing sensible about it. It's just literally a bunch of systems that have to move quick and have a pretty rigid rule set. Like, do have to do something, and it's not always friendly. You guys, anybody on the banking side, anybody actually on this call if anybody institutional side, you know exactly what I'm talking about. Liquidity is not what it used to be. Like since COVID, you cannot get things done in any kind of size when you need to get things done in size.
The closest parallel I remember was Jacobians and working with stability models. And in one certain where you have the regime where you're at, right, and whatever your current parameters are, let's say price is a current parameter, you have instability. But if you shift slightly higher, all of a sudden you have stability, kind of like one of those things that we'll see. And it'll kind of cause a cyclical effect. And then like once it gets to that level, it's like stabilize, chill for a bit. And then all of a sudden you see the wind come out of the sails essentially, right?
Yeah. Yeah, I guess we'll kind of wrap up pretty quickly, right? Because it's Father's Day and you have some grilling to do. Good for you to wait.
I do indeed. It's way too hot. It was 103 degrees here.
Oh my God, no, I'm with you. It doesn't get that hot here.
My wife's like, yeah, when are you going to start the grill? I'm like,
the first thing is grill itself. You just put it outside for the day.
Yeah.
No, we had
I think I hear the dog barking.
But just like a little bit of look ahead of June. What I would say is just a little bit careful. Obviously, I guess I should plug the Discord stuff too. Like we'll talk about this every day in the Discord membership. We'll actually have intraday like dealer hedge dynamics calls about the June position specifically. And then I guess it's weird to do it on a holiday, but we will do the OPEX call on Thursday to look at the positions in June as normal. Maybe it'll be a little earlier in the day. I don't know. We'll figure it out. But
I'm here every day because it's a day. It's a weekday.
Yeah. It's every day's a work day for me anyways.
Yeah, exactly.
Yeah. But what I was going to say is like with even just a brief look at the position, there's like this problem right now is pretty vexing because you have a situation where I'm looking at tomorrow's position right now, for example, and clearly there is a bullish impulse coming out of the decay flow if we don't gap lower. Right? Yeah. Like that's natural. Like it has a top side boundary, a pretty expensive straddle right now. It's like $60. But it's going to wind up creating a local decay profile that's going to find support again and stability around 6,000 if we don't really gap. And when I gap, I do mean like, I guess that's a little overstatement. If we don't move more than the price of the straddle to the downside. But that said, what's going to happen throughout the week is you have this funny thing where like there's a little bit of stability here. I bet you I wouldn't be surprised if we saw something on Tuesday, maybe some local hedging. But then the strange part is like, so July calls, that July structure will still be there. That's still going to be driving like the Vanna influence. And when I say Vanna, I mean not 0 day, real vol changes, right? Things that actually can move and
things on the curve.
And they hold their price, right? If the July straddle goes up $20, it's not expiring tomorrow too. Whereas 0 day straddle can go up to $80, and yes, that's Vanna, but it's also going to expire at zero at the end of the day. And so it's completely overtaken by decay. Whereas July is not the case. Like that vol influence can really perk up and hold its own and persist with an influence that is causative in terms of delta, more than 1 day or 2 day time frame. Whereas like the near dated stuff, the June is not so bullish either. And so we're going to have this weird thing where if we have the term structure kind of bidding because people are hedging out July, like risk in July, which does two things, right? You want to give yourself enough. We've had it, and I know this sounds like Groundhog Day for some of you guys. We've had this happen a couple of times. We had it happen in March. We had it happen again in the end of May or beginning of June. We had that kind of shallow dip, but it's happening again where there's this reason that you want to be hedged with a tender that's not 0 day, right? If we have July 9th as this like bifurcation where there's a trade deal that needs to happen or not happen before, after the deadline, you want coverage for that. So you need to buy options after July 9th. You need to actually buy something that has real a term to it. Same thing for this idea of this war right now breaking out. Like it's not going to be a yay or nay, like thumbs up or thumbs down, ceasefire today. this conflict, will probably drag on a little bit, and people want to hedge a little bit farther out. Well, it'll be interesting if we have this bidding in the term structure, like buying of calendars from June and beyond, or end of June and beyond, because it'll do the same thing where like the pressure from both sides of this, from buying vol, it will force VIX up, which will force bidding on the market maker profile in one sense. But then the decay flow will pull us down a little bit towards like 5,900, 58.5 from the June position and the June quarterly position. And so there's going to be this weird tension, this kind of like balancing act. I guess it's a little bit different than what we had in March and earlier in June, because the positioning was actually the opposite in the longer dated. So I should rewind that a little bit and say the strange thing is this actually causes more tension, more back and forth, like more erratic movement. And the bigger risk is that if we start to see a lot of puts bid, and we saw like TDEX bid last week, we saw VVIX kind of start to really creep higher. And so the risk
VVIX started,
yeah. So if you have a lot of tails being opened up on the put side, the left side, while we're still in this local range, it's kind of sneaky because all it takes is 1 or 2% to slide out of it, and you're going to have skew go nuclear, and all of a sudden the Vanna profile is not friendly anymore to bidding a vol. We'll slide into a range where if we go back down to like 5,900 or 58.5, it'll be the opposite, where like bidding a vol now will force a hard sell into like this dynamic where everybody had already been kind of tricked or deceived to think that, oh, it's just summer of George, like local flows are easy and we're going to chop around this local range. It's safe to buy in. It's like the sentiment is like the worst of the negative gamma. It's like the last in, and then they're screwed.
And it kind of brings up a point from one of our favorites from back when, Dogman, ABCs. Always be hedged, right?
Yeah.
Always be hedged.
Yeah, and I don't like to be a doomsdayist, and I know it's my wife was pointing this out too. She's like, you should sound more excited when I'm like, but it's so boring when it's bullish. Everybody can spot when it's bullish. For me, like my whole career is like figure out when there's a strain. Like if you can figure out where there's a problem, you can compound it at a much better rate. That doesn't mean be a doomsdayist or like a bear market cultist or whatever, because that's stupid.
The daily calls were also pretty bullish, right? Pretty bullish in some daily calls too, right? So like we'll talk about.
Yeah, you can't avoid it. It's like
day where, like
by the profile.
Yeah, this is the day where like there's really no demand in vol. Like I would expect it to just absolutely decimate, and we saw that many times. So
yeah, exactly. But you have to know when to like not get your face ripped off. Like if you want longevity, like even if it's just like, hey, get out of the way for a little bit, it's a good time to hedge. You don't need to hedge. You can just maybe stop buying or take a little bit of a pause.
Just reduce your deltas.
Yeah, or buy. I like these structures where like you can actually point certain areas where like we're probably not going to go hard through that right away, right? Like I picked this June put fly because I knew like, okay, we don't have a hard sell coming in the next like day or two because there's so much support down by 58,900 for so many reasons, and we could lose that pretty quickly, of course. But like the balance is the probability says we're going to probably find a retracement that is shallow, right? And so why overspend on the wrong thing when you can pay $15 for something that might pay out 150?
Yep.
Yeah.
Kind of goes back to that 1x2 structure all over again.
Well, I would slide off though. I would never tell. I never
always slide off.
Even my own trading, like I don't even like the idea of holding things where you could just get hosed. Like, yeah, you can have portfolio margin and have a 1x2 open, but sure. But like if you actually have these memories of what happens on days when you gap down significantly, it's not friendly. It's not easy to cover. And I'm speaking from my career as a market maker too. And on the retail side, I would feel. I can't even imagine what it would be like trying to deal with the markets as they are when you open in those kind of situations and there's no visibility, there's no liquidity, and things are super wide and moving 1 or 2% every couple of minutes. It's just like I don't want to be there.
Carrying a short position in the index is no joke. Like you need to have some structure behind it. You need to have some understanding of what you're doing because markets go burr and that shit hurts. And
I was speaking short vol. I was speaking short vol, but either way. Yeah.
So, but yeah, I gotta go. It was great. See you. Once again, happy Father's Day, brother, and happy Father's Day to all you guys out there as well.
And all the dads on the call, of course, for sure.
Yeah. Later, guys, and see you during the week.
Yeah, talk to you guys in the morning too. All right, peace.